The date is February 2nd, 2026. In New York, the trading screens are flashing red. Panic is in the air. Silver has just crashed 36% in a single session, plummeting to $73 an ounce. Gold has broken below $4,500. To the average investor, this looks like a collapse. It looks like the end of the precious metals bull market. But if you look across the world to Moscow, to Beijing, to Brasilia, you see a very different picture. You do not see panic. You see calculation. While the West is selling paper, the East is building a fortress. We are witnessing the opening shots of the clash of the titans. On one side, we have the Warsh Dollar, a revitalized, aggressive, hard money American greenback led by the new Federal Reserve nominee, Kevin Warsh. His mission is to save the dollar by shrinking the supply, crushing inflation, and restoring faith in the fiat system. On the other side, we have the unit, a revolutionary new trade currency from the BRICS alliance. It is not based on faith. It is not based on promises. It is based on a mathematical formula anchored by 40% physical gold. This is the battle for the next world reserve currency. I am the financial coin historian. Today we are going to deconstruct this war. We will show you why the crash of February 80 was not an organic market move, but a dollar strike, a tactical weapon used to defend the American empire. We will break down the exact technical formula of the unit and why it terrifies the Western banking system. And we will answer the ultimate question. In a war between a dollar backed by debt and a unit backed by gold, who wins by the end of this decade? The old world is dying. The new one is being minted. Let's open the ledger. To understand the future, we must first analyze the crime scene of the present. Let's go back to the morning of February 2nd. Spot silver was trading near $121. Gold was flirting with $5,600. The debasement trade, the bet that the US government would print money forever, was in full swing. Then in a matter of hours, the floor fell out. Silver crashed to $73. Gold lost nearly $1 trillion in market cap. The media told you this was profit-taking. They told you it was a reaction to technical indicators. They lied. This was a dollar strike. Our forensic analysis of the market data reveals a coordinated effort to break the psychology of the metals market. It began with the CME Group, the exchange that controls futures contracts. On the eve of the crash, they raised margin requirements aggressively. This forced leverage traders, the speculators who had borrowed money to buy silver, to come up with cash instantly. They couldn't, so they sold. This only triggered a liquidation cascade. Simultaneously, we saw a massive wave of crypto margin calls, nearly $1.7 billion. Crypto investors desperate for liquidity dumped their gold and silver positions to save their Bitcoin. But the timing is the key. This crash happened exactly as news broke of Kevin Warsh's nomination to the Federal Reserve. Warsh is known as a hard money advocate. The market interpreted his arrival as the end of easy money. The dollar strike was a message from the establishment. We will not let the dollar die without a fight. We will crush the price of gold to prove that cash is still king. It was a display of brute force. By crashing the price of silver, they successfully spooked the retail investor. They made you feel foolish for holding metal. But while you were panic selling at $73, who was buying? The answer leads us directly to the enemy they are trying to defeat. While the West plays games with paper futures contracts, the BRICS alliance, Brazil, Russia, India, China, South Africa, and their new partners has been building something real. For years, we heard rumors of a BRICS currency. Critics called it a fantasy. They said 5 countries with different economies could never agree on a single money. They were wrong because they were thinking about a Euro-style currency. The BRICS have not built a currency for you to use at the grocery store. They have built a unit of account for global trade. They call it the unit. And unlike the dollar, the euro, or the yen, we now know exactly what it is made of. We have the formula. The value of one unit is derived from a weighted basket. Here's the equation. The unit value equals 0.40 asterisk gold plus the sum of 0.12 times the 5 core currencies. Let me translate that into plain English. The unit is anchored 40% by physical gold. The remaining 60% is split equally 12% each among the Brazilian real, the Chinese yuan, the Indian rupee, the Russian ruble, and the South African rand. Why this specific mix? This is the genius of the design. The 40% gold anchor provides a hard floor. It means the currency can never go to zero. It creates a natural hedge against inflation. If fiat currencies collapse, the gold component rises, stabilizing the unit. The 60% currency basket allows for liquidity. It ties the unit to the actual economic output of these nations, their energy, their manufacturing, their agriculture. This is not a fiat currency backed by faith and credit. It is a resource-backed currency backed by gold and labor. The pilot project launched by the Institute of Economic Strategy in Moscow has already tested this. They issued tokens pegged to this formula. When the markets crashed on February 2nd, the unit did not crash. It adjusted because it is 40% gold. It is immune to the debt problems of any single nation. If Brazil has a crisis, it only affects 12% of the unit. If China has a crisis, 12%. But the 40% gold anchor remains solid. This is the mile financial shield. The East has built to protect itself from the weaponized US dollar. They know they cannot trust the Federal Reserve. So they built a system that trusts mathematics and metal. Washington is not blind. They see the unit rising. They see the threat. And their response is Kevin Warsh. The nomination of Warsh as Fed chair is the most significant monetary event since Paul Volcker in 1979. Kevin Warsh is not a typical central banker. He is not a Keynesian who believes you can print your way to prosperity. He believes in sound money. His vision is to out-hard money the BRICS. How does he plan to do this? By aggressively shrinking the Federal Reserve's balance sheet. Currently, the Fed sits on over $7 trillion of assets. Warsh views this as a bloated subsidy for Wall Street. He argues that this easy money has created a zombie economy where fake companies survive on cheap debt while real Americans suffer from inflation. Warsh's plan is a neo-Icarian pivot. He wants to drain the liquidity from the system. He wants to stop the printing press. His bet is on the AI productivity boom. Warsh believes that artificial intelligence will create a massive deflationary wave, making goods and services cheaper. He argues that if the Fed stops printing money, the dollar will strengthen and the cost of living will fall because of this new technology. He wants to make the dollar scarce again. This is why the markets crashed on February 2nd. They realized that the Fed put the guarantee that the central bank would always save the stock market is gone. Warsh is willing to let the stock market fall if it means saving the dollar's reputation. He is trying to tell the world, you don't need the BRICS unit. The US dollar is the hardest currency on earth. It is a bold gamble. If he succeeds, he restores the American empire. But if he fails, if he drains too much liquidity too fast, he risks triggering a collapse that makes 2008 look like a picnic. And we are already seeing the first casualties of this strategy. You cannot turn off the money tap without breaking the pipes. The transition to Warsh's hard money world has created a liquidity vacuum, and the first victim of this vacuum was Metropolitan Capital Bank and Trust. When this Chicago-based bank collapsed, the media blamed bad management. But the historian looks deeper. Metropolitan Capital failed because the flow of dollars in the global system is drying up. As the BRICS nations move toward the unit and trade, in local currencies, they are holding fewer dollars in their accounts. This is dollarization in practice. When China pays Brazil in yuan or India pays Russia in rupees, those dollars do not flow back into the US banking system. Banks like Metropolitan rely on that flow. They rely on cheap, abundant funding. When that funding disappears, they become insolvent. This failure is a warning shot. It proves that dollarization has a cost. It proves that the US banking system is addicted to the exorbitant privilege of the dollar. If the world stops using dollars, US banks lose their deposits, US interest rates rise, and US assets collapse. But it's not just banks. Look at the United Nations. The UN is facing a historic funding crisis. Why? Because the liquidity is gone. The US owes billions in unpaid dues. The global machinery that runs on dollars is grinding to a halt. This is the Warsh shock in action. By trying to harden the dollar, he is exposing the fragility of the entire debt-based system. He is draining the swamp, but he might drain the ocean. This brings us to the most critical signal in the market today, the Great Divergence. On February the 2nd, when the paper price of silver crashed to $73, something strange happened in the physical market. In New York and London, traders were panic selling paper silver futures contracts that claim to represent silver but are really just bets on price. But in Shanghai, in Mumbai, and in Moscow, buyers were stepping in. The Shanghai Gold Exchange saw record volumes. The premiums on physical bars skyrocketed. Why? Because the East knows the difference between price and value. They saw the $73 price tag not as a crash, but as a generational entry point. China and Russia have been systematically accumulating gold for years. Their central banks bought over 1,000 tons last year alone. Now, with the price suppressed by Western paper markets, they are accelerating. They're using the West's dollar strike against us. The West sells paper to raise cash. The East pays cash to take the metal. This is a transfer of real wealth from West to East on a scale never seen before. This divergence creates a delivery crunch. The COMEX in New York claims to have silver. But as industrial users and Eastern nations demand physical delivery, those stockpiles are draining. We are moving toward a world where there are two prices for gold and silver. The paper price manipulated by interest rates and algorithms in the West, and the physical price dictated by scarcity and strategic demand in the East. The BRICS unit is built on the physical price. The Warsh Dollar is defending the paper price. And history tells us that eventually the paper burns and the metal remains. So where does this war end? Who wins the battle for the reserve currency of the next decade? We are looking at two distinct futures. Scenario 1, the Warsh victory. In this scenario, Kevin Warsh succeeds. He shrinks the Fed's balance sheet. The AI productivity boom arrives, lowering costs and boosting the US economy. The dollar strengthens, crushing inflation. The BRICS unit remains a regional experiment used only for settling oil and grain trades between member states. The dollar remains the king of global finance, albeit a stricter, harder king. Scenario 2, the split. In this scenario, the liquidity vacuum becomes too strong. More banks fail. The US economy, addicted to debt, cannot handle the withdrawal of easy money. The Fed is forced to reverse course and print money again to save the system. The moment they turn the printers back on, trust in the dollar evaporates. The BRICS unit, anchored by gold, becomes the preferred safe haven for global trade. The world splits into two monetary zones. The digital fiat West running on surveillance CBDCs and managed currencies, and the commodity-backed East running on the unit gold and tangible resources. The verdict of 2026 is that the unipolar moment is over. The US dollar will no longer be the only option. It will have to compete. And in a competition between a currency backed by 37 trillion of debt and a currency backed by 40% gold, the market will eventually choose the metal. The BRICSization of the global economy is already at 72% for member nations. The momentum is undeniable. So what is your verdict? Do you hold the currency of the past, the debt-based dollar? Or do you position yourself for the currency of the future, assets that are finite, tangible, and sovereign? The clash of the titans has begun. The ground is shaking. Do not be standing on the fault line when it breaks. The events of February 2026 are not just market noise. They are the sound of the old order breaking. The February 2nd aftershock was a tactical victory for the dollar, but a strategic defeat for the system. It revealed that the West must use brute force to keep the price of gold down. It revealed that the East is ready to absorb that gold and use it to build a new system. The unit is coming. It is mathematical. It is resource-backed. It is inevitable. The Warsh Dollar is a noble attempt to return to sanity, but it may be too late to save a system built on debt. You must choose your own reserve currency. Will you trust the algorithm of the central bank or the arithmetic of gold? The winners of this decade will be the ones who understand that in the end, wealth is not what you can print. It is what you can hold. I am the financial coin historian. The war is on. The ledger is open. Choose your side.